Happy to answer them. So,
Thanks, Morgan. And as you were talking, I just had a thought here. It might be just throwing something against the wall, but since Sharon's in Hawaii, maybe we ought to consider doing some type of live event over there, considering it's a balmy 35 degrees here this morning. December might be a perfect time. So appreciate the introduction. The slides are loaded up. I want to thank everybody for joining. We got a great group from all over the world, and it looks like Morgan's agreeing to that live event oh, hey, and thanks, Don. Hope you enjoyed the Tampa event, and hopefully, we do something in Hawaii, and hopefully we hit basically every jurisdiction. But we'll get started. I don't want to take a ton of time today. I'm going to cover a few things here, but Daryl Martin, who's up right after me, is really going to go a lot more in depth into what what I can do. And Daryl, yes, you can be the featured speaker in Hawaii as well. So let's get started. What we're going to talk about today is just a quick overview of who Nadex is. I know a lot of people aren't familiar. We're relatively new on the exchange scene, been around a few years, but we're going to cover a little bit about Nadex, and we're going to talk a little bit about one of the contracts we offer, the bull spreads. And what you'll hear Daryl mention, we call these bull spreads, although we all agree we hate the name. Think of them as box spreads because they're both bullish and bearish. We're going to take a quick look at a strategy, and then we're going to cover a quick thing about costs. And as always, we'll take questions as we go along. Quick risk disclosure. Hopefully we all understand that anytime we put money into a market, it's at risk. If we put money up for a trade, we can lose that money. We can have the best strategy in the world. Some trades lose, some trades are profitable. But this is what I'm going to present is for educational purposes. I'm not going to, I might show a chart or two, but I'm not going to recommend, hey, I think oil's going up or I think oil's going down. So just keep that in mind. This is for education. And as Morgan mentioned, no sales pitches here today. It's just all about education. So who is Nadex? Nadex is the North American Derivatives Exchange. We are an exchange. We're kind of unique in that we're the only exchange that accepts direct retail members, meaning a retail trader can actually become a member of the exchange. You don't have to put up millions of dollars to join the exchange. It's actually pretty low cost of entry. We're not taking the other side of your trade. So while we might look like a broker because you can open an account, we're not. We're never taking the other side of your trade. We're simply an exchange. We're here to match buyers and sellers, and that's it. We're absolutely unbiased. We are CFTC registered. We're all electronic. DCM, DCO, those are just two acronyms. DCM means we're a market, similar to CME's designation. We're also a DCO, which is a self-clearing organization. What really makes us unique is all of our contracts, as Morgan mentioned, are designed for the retail trader. I know there's probably quite a few people on the call and on this webinar that have traded futures in the past, and as we see margins go up, gold I think had something like 5 margin raises last year. It becomes very difficult very quick, unless you've got $25,000, $50,000 to really participate, whether it be because of margin or market risk. One of the things with Nadex is really that all of our contracts are designed for you, the retail trader. So low cost of entry, all limited risk, fully collateralized. So when you put on a trade, you know up front what your maximum exposure is. One thing you didn't see in the risk disclaimer was that you can lose more money than you have in your account, which is true of any leveraged market. That's not the case with Nadex. These are basically options for non-options traders. And so you get all the, I guess, risk benefits of knowing what you're putting up when you get into the trade. And as I mentioned, we're the only exchange that accepts you as direct members. So let's take a look at a bull spread. And Daryl's going to really cover these, I believe, a lot more in depth and does a great job. So we're just going to kind of go over them at a high level view and a couple of the benefits here for you. So a bull spread. These are pretty simple short-term contracts. If you've traded options before, it's basically a vertical call spread. That's all it is. What we've done though is taken that very simple strategy and really made it even more simple. We put the ranges. There's multiple ranges each day on each underlying market. And so what you have is a limited risk contract. There's a floor and a ceiling. This will probably make more sense when we actually look at the charts. but there's a floor and a ceiling. So if I'm long, the floor is limiting my risk. If I'm short, the ceiling's limiting my risk. All of them are priced, as I mentioned earlier, for the retail trader. So $1 per tick. Uh, so instead of going in and maybe where if I have 1 point on oil, it's $1,000, and we'll take a look at that in a minute. I can do that for every penny oil moves. It's only $1 rather than $10 on the actual underlying market. And Morgan just posted there. Yeah, gold's about $10,000 overnight. Silver close to 7,000 per contract in futures. Um, I'll just mention it real quick. You can trade both gold and silver on Nadex for a lot less than that. Actually, with the contracts that we're going to take a look at, it could be as low as $25 or $50. So you can always scale up, but you can also have a nice low level of entry to get in. So let's just take a quick look at a chart, and this is an oil chart. And excuse me if my voice is a little bit hoarse. I think the guy sneezing behind me on the plane yesterday gave me a little bit of a cold. But this is an oil chart, and oil's trading around 75. So I put that line up there. Let's say we're going to buy oil at 75. This could be any market. This could be the S&P. This could be currencies, whatever you're used to trading. If I took away basically the labels, just think of it as any example of what you currently trade, because the basic premise is the same. When we're getting into a contract, we're either buying or selling, and so let's say we're buying oil, we put our stop somewhere. In this case, if we put a stop on, let's see. Hopefully, can everybody else see the chart? I see Ben just said that can't see the chart. Hopefully most of you can. Hmm, that's odd. I'm not sure. Okay, I'm sorry. You know what? The chart will be up in a second. The price is actually. Let me highlight that. I think I just realized it's a little bit small on the screen. All we have are price bars right here. We're gonna get to the actual movement of the price in just a moment. Just pay attention to the lines for a second. So you've got a 75, and we put a stop in, right? As traders, we've got to manage our risk. Now, if I'm trading oil, I think if I was trading on straight up margin, something around $6,800, and my risk on this trade with a $1 stop is $1,000. And so I'm putting up 6,800 to trade this contract, and I've got a $1,000 risk. And we've probably all been here and seen this happen. Hopefully you can see the price now ticking across the screen. We get stopped out. Not uncommon. Sometimes it goes in our favor. Sometimes we get stopped out. Um, I don't know if he's on this morning, but Larry Pesavento, one time told me that the difference between him and a lot of retail traders was that he gets out of his losing trades faster, right? We can't let the trade run against us, so we have to use that stop, but that means we do get stopped out quite a bit. Now, more painful than even getting stopped out is when we see something like that. Price drops down through our stop or even just hits it by the tick and then bounces up in our favor or goes back down in our favor. Has anybody ever had that happen to them? It's quite common. I'm probably notorious for it. I don't know how many times it's happened to me where I hit it and it was just bam. It was almost like the market had eyes and it went down. And yeah, as Daryl said, anybody that's ever hit a trade has had that happen. And it can be kind of frustrating. We have to limit our risk, but how do we do that without stops? Tamar, we might have you be the guest speaker then if it's never happened to you. What we have with this and what we can use is what's called a bull spread, which it has the benefits of being an options type trade, but without all of the, I guess, effort that takes into learning options, knowing where to buy your call, sell your call, all of the Greeks. So let's take, this is the same chart, and again, the price is just right over here. What we have, because there's multiple ranges posted each day, we may have a floor at 75 and a ceiling at 80. This is a range. Think of it as a box spread in this case. So the floor of this contract is going to limit our risk. Now, we've got an expiration time. These are short-term contracts. We will take a quick look, though, at how we can use these for more of a swing-type trade. So we've got an expiration. So the contract expires. In this case, we're going to be buying right around 75.25. Now, the first question will be, well, why would I give up 25 ticks to the market? I mean, that seems kind of, illogical. Why would I give up that much edge? And the reason is the protection. This is a trade that we're not going to require a stop on because our risk is absolutely limited. We know it up front. We've got 25 ticks risk on this particular trade. We've got basically a 500 tick spread from 75 to 80, 25 ticks risk on this trade. 75-25. If we wanted to trade the equivalent of an oil future, we'd do 10 contracts. So every point oil moves, our spread moves $1,000 as well. So we've got our risk fixed. This is also a limited reward contract, so our maximum gain is up to 80, which is a pretty sizable move. I think anybody would be happy putting up 25 to make 475. Now what happens? The market does the same thing, but we don't have a stop. Our maximum exposure was at $75. So we had $25 risk on one contract, $250 if we were looking at 10, no stop. By the way, instead of putting up 6,800 in margin, our margin was our risk. Our collateral was our risk, $250 to trade 10 contracts. So we can see where the cost effect really comes in. Also, because there's not a stop, now if the market does that and it bounces back in our favor, if it's in our favor when it expires, then we make that money. We can also close these out early, which I'll get into in just a second. But instead of having a stop there, price was able to trade through our lower boundary, and we were able to have time for it to come back. Little different scenario. Price just shoots up in our favor. Fantastic. We can be profitable up to 80. If it continues to run, then we could actually consider getting into the underlying market, because now if we bought oil at 80 in the underlying market, we could put our stop around 79, but it would already be net profitable. We wouldn't have a stop that was in the risk category, more of a management stop where to take profit. Another scenario, price moves. If we let it go to expiration, it's wherever it settles in that range. Again, if it settles over 80, the maximum we can make is 80. If it settles below 75, let's say it settled at 74, the most we can lose is down to 75. If we were short on this contract at 80, the most we could lose would be 80, and so the floor and ceiling caps it. Now, when this expires, we can leave it till expiration, and if it settles at 77, we bought at 75.25, it settles at 77, we made our 175 ticks, or $175 per contract. So we can see basically what I call as high effective leverage, because think about it, if you're doing an equivalent of 10 contracts, 175 ticks is $1,750. But you only had $250 exposure versus the $6,800 you might have to put up on the futures contract if you did the same thing for $250. You can also sell anywhere, and I recommend, particularly if you're trading in fast-moving markets, set a limit out there. You can take off a full or a partial part of your position. So if I trade 10 contracts, maybe I want to put a sell order out there to take 5 of them off, and maybe another one to take another 2 off, and then let 3 go to expiration. Let's see. Jane asked a question. Could you tell me what is on the screen at present, please? This is just an oil contract, and the range you see there is basically the range of the contract. There's no slippage, actually, TJ. One, there's no stops, so it's not like you can have a market gap. Let's say we got in at 75.25. and oil dropped to 73. It can't close below 75. I can't slip below 75. With if we're hitting limit orders, there's no slippage on a limit order, and where it expires is actually taking the underlying and averaging out the last 25 ticks. Basically, take the 5 high, 5 low, throw those out, averages remaining 15. And actually, Chris, as Darrow mentioned, he will cover it. And Mark, I don't know if that was a question. The bid ask is wide. In some contracts, and depending on where you're trading it, the bid ask can be kind of wide. One of the things I'm actually looking at doing right now is actually bringing on some more market makers. I've been talking to a few of them. It's been a bit coming, but what we're going to see is the spreads tighten up quite a bit, make it look more like the underlying, and that's the goal. And the bid offer is a little bit wide, but if I actually have to pay, let's say I pay 20% more than what I would in the futures market, or even 50% more, not getting stopped out, if I look at the average, I'm still making more, even with a little bit wider bid ask. But we are trying to get that down. And as Daryl mentioned, he'll cover the basic of this trade. So let's just take a look. This is an example of the multiple ranges. So we have the market at 8 a.m. because we're continually making various ranges throughout the day. We have daily ranges, which cover a much broader spectrum of the market. And so typically we'll have the market right here. It's at the center. And then in this case, it's a currency. We'll make it 300 pips above, 300 pips below. We also have shorter term ranges. The basic premise is here, you always have a floor and a ceiling to work with. So long or short, you should have an area where you can get in relatively limited in your exposure and basically be able to put a position on based on your bias in the market. Then we even have shorter spreads. So we have one that covers the center part of the market, and then we have one that goes up from there and one that goes down from there. And so if I was long, I have multiple floors and ceilings, and that's the whole premise. As the market moves, here it is at 9 a.m., 1 hour later, we have new spreads that come in. Let's see. So do you win with the bull spread and with the underlying too? Well, we're going to actually take a look at a strategy, and I think Daryl's going to cover how to do those simultaneously. And so what you have is Nadex is a separate exchange, so that's not fungible with any other contract. So if I'm trading oil on Nadex, I can't put that position into basically an oil contract in the underlying. How does Nadex make money? As an exchange, we have an exchange fee, which I think I'll cover real briefly at the end of my part of the presentation. And we've actually just adjusted those. Some of you, I recognize a few names on here. I think you're already actively trading with us. Probably saw the announcement at the beginning of September on our capping our exchange fees. And so we'll get to that in just a couple minutes. So let's just take a look at a real quick one. And this is something probably similar to what Daryl's going to cover, only he does a much better job, which is why he's the featured speaker and I'm just kind of the introducer. So let's just say we're getting long into a position. And this is the same trade. It could be just about any other, any market really. Oil, gold, silver, copper, currencies, indices. We always place a trade. And so we've got our long position. This is the Euro USD. And so this is going to take a look at how we can hedge some entry exposure, because I think it goes very well to the question that was just asked. Basically, does this mean I make money in the underlying? What we're going to look at here is actually we're hoping that what we trade on Nadex is a loser. And I'll tell you why in just a second. So we're long in our position. Maybe we look for a place again to put a stop. The market could move against us and stop us out, right? We always hear manage your risk, manage your risk. But oftentimes what that translates to is well, I smothered the market with my stop. Or even if I was a bit, left it a little bit liberal and kept it a bit of ways, I still got stopped out. It's only I lost more than if I would have been tight on the market. So placing the stop is really difficult. I think we can pretty much all agree on. So let's take a look, and this is just a zoomed in portion of that slide. We're long the Euro USD underlying at 131.35. Got a stop at 130.10. That's pretty far away. That's probably bigger than any stop I've ever used in any currency trade I'd ever done. I was typically more like the 35 to 40 pips. In this case, though, we might look to a spread. So we're going long the underlying. Now we're going to basically look to buy insurance. And that's what I call this contract, insurance. We've got this range. In this case, it's from 131.50 down to 129.00. So it's 250 pips wide. I'm going to sell 10 spread contracts. Again, I'm giving up a little bit of optionality to the market, so I'm selling 10 at 131.25 with the market trading right around 131.35. What this allows me to do, again, because my risk is limited, I'm just trying to buy insurance here. Maybe I'm in a position or I'm getting into a position and there's a lot of news out of Europe, there's a lot of stuff going on and I'm a bit concerned about it. I want to protect that. I want to take as little risk as possible, but yet still have a decent sized reward. In this case, my entire risk, because I'm going long the underlying at 131.35 and selling the spread at 131.25, I can lose 10 pips. It's a 10 pip difference. If I trade 10 contracts to make it an equivalent of my long position, I sell 10 spread contracts. What I'm trying to do here is because I'm long the underlying, I think the euro is going to go up, but just in case it comes back and kind of crushes me, I don't want to take a big loss. I don't want to have my stop sitting at 130.10. We've got a spread floor down to 129.00. What this allows us to do now is we can move our stop in the underlying market all the way down to our floor because that's our protection. That's the distance of our protection. So now instead of putting on a Euro USD where I had a stop, let's say 125 pips away or even 40 or 50, now I can move it almost 250 pips away. In this case, 235 pips away. But I have a stop 235 pips away. I'm only taking 10 pips risk per contract. So if something like this happens, well, in that case, the market's now here. I've lost in my underlying position. So my long position that I bought here is now down here. But my spread position that I sold here has made up all but 10 pips of my long position. So it's a hedge, but one thing you don't want to do is really hedge a speculative position, right? Because a true hedge is about limiting risk. So we want to make sure that if this works in our favor, if the underlying does go up, we're not losing everything. But here we go, and now I could close out my spread contract and move my stop up in the underlying. I could figure out how to manage my position. I've given myself time to be right. Now, if this happens, as I just mentioned, one of the downsides to hedging, when you're hedging a speculative position, the term hedging really implies fixing my costs, right? If I'm a farmer and I've got grain coming in, pretty tough year. Actually, I grew up on a farm, and a lot of my friends are still out there. Pretty tough year, as we've seen across the nation on corn and various commodities. Farmers hedge. Speculators need to make money. So a true hedge is there to limit risk, fix costs. So I know at the beginning of the year what I'm putting in is what I'm going to get out basically at the end of the year. With this, though, we can use the bull spread to effectively buy insurance, and price moves up. Now price moved up. Once it passes the ceiling of the spread contract, we're making money. We're being profitable. Because our spread is limited risk, that goes up. It goes past the ceiling. Now every pip in the underlying, every point, every tick, we're making money. We bought our insurance. It did its job. We're effectively paying a small premium for a whole lot of insurance. This is also one way, and I think we can take a look at it in just a second. Let me go here. Oop. Let me flip back to this screen. Make a couple more points. If we had a long-term position, so let's say, I'm just going to flip back here real quick. Let's say this was a swing trade, because a lot of people ask, I've got a very short-term contract. How do I use that as a swing trade? I'm a swing trader. I leave my positions in for 3 or 4 days. This is exactly how you can use these to become a swing trader. Keep in mind, when we swing trade, I often say everybody should be a short-term trader but be in a position to be a swing trader. What I mean by that is that basically all of your risk should be up front on a trade, any trade. It doesn't matter if it's a trade that's supposed to last 15 minutes or a trade that you think is going to last 15 days. Nobody is a swing trader, at least a successful one, if they let the market run against them for 3 days. You don't stay in a position being a swing trader that's going against you. Going back to the previous point about Larry Pesavento, he always made that comment, get out of the losers quick. Here we can have time. We actually don't even have to get out of them that quick because in this case, if we had an 8-hour contract, we can let the market do whatever it's going to do for 8 hours. If it runs in our favor, fantastic. We've still got our long position on. But if it doesn't, we've got that protection there. All of the risk on a swing trade should be what, in the first half hour, 2 hours, 5 hours at most? Because if the market's not doing what you expected it to do, then what happened to your analysis? So you close out that trade. But here, by using this combination, you can actually do both. You can kind of have the best of both worlds for this trade. You can have a market that either right away runs in your favor and you go, hey, I'm profitable, or you can have one that goes against your initial bias and you go, well, that's okay because I only took a really small loss and I had a bit more time to be right and didn't have to worry about getting stopped out. Hopefully that makes a little bit of sense. And I'm actually going to wrap up a little bit quicker here today because I know Daryl's got some things. Let's see, I got a question here. Don't you use indicators to help determine where the market is heading? Yes. And that's actually a great point there. One thing you want to do, Nadex, we can publish. We're actually releasing the charts for the underlying currency markets, but the CME has a bit of an issue if we release the underlying charts on their contracts. We are another exchange after all. And let's see. Hold on, we had a few questions come across here. On the indicators. So you want to use the underlying charts because our charts are for our contracts. Use the underlying charts to actually take your bias. I don't use a ton of indicators when I was trading. I used fib ratios, patterns, support and resistance levels, some pretty basic stuff. TJ asked the question, how much margin did the short spread cost? The short spread, we sold it at 131.25. The ceiling was at 131.50. So we had 25 pips risk, $25 per contract, 250 bucks. Whatever our risk is on the spread, that's what our collateral / margin would be. If I sold it at 131.00, I'd have 50 pips risk, so $50 per contract. And that's kind of the benefit. It can be very low collateral to get into the trade and actually buy that insurance. If the market doesn't move at all, by the way, I've basically given up 10 pips. Wayne, what are you buying and what are you selling? Basically, this is the contract. It's an options contract. It's a derivative of the underlying market. So in this case, we were selling a Euro USD bull spread contract. And so if it went to 129 and you closed both, what would the net have been, is the question. If it went down to 129.00, we went long at 131.35. It went to 129.00. If we just did the underlying, obviously that's pretty easy math. We'd have lost 235 pips. But by using the spread, we lost 10. My net was 10 because I'm protected down to 129.00, not including exchange fees, which I'll cover in just a moment. Yeah, Abu makes the great point there. You don't have to be fixed to your screen all the time. You place the order. You can leave it till expiration. I prefer, and it's all just kind of my preference, and I guess everybody trades a little bit differently. I'll typically try to get some limit out there as quick as possible, only because a lot of times around expiration, depending on the length of the contract and depending if it's expiring near the or near the time the futures are closing, you can see some kind of crazy movements. So if it's getting close, I like to maybe take a little bit of profit. Let's see. Actually, Frank, I think Daryl's going to simplify it a lot more. And one of the things I recommend, open up a demo account first. Definitely do, because these are a little bit different, but you can see very quickly it's very similar to trading the underlying charts. Let's see. And it looks like Daryl's actually answering a lot of the questions for me, which is awesome. Thanks, Daryl. There's quite a few that came across there. So let's talk about the cost. As far as margin, whatever your risk is on the trade, that's what your collateral is. That's why you can't ever lose any more than is in your account. If you've got 500 bucks in your account and you put 100 bucks up on a trade, all of a sudden it goes, okay, it goes against me. I put 100 bucks up. Unlike in the currencies, which are 50 to 1, typically in the US anyway, I could lose 50 times basically what I put up. That's just how it is. I can't with a spread. So my risk is my margin. And let's see here. Let's get into the other part of the costs. Let me go here. Whoops. To become a member of Nadex, there's no membership fee. The actual initial deposit is 100 bucks. So you can get in for very low cost. You can obviously put in 5, 10, 100,000 if you like, but very low cost of entry. And the reason is because you can trade a single contract for as low as 4 or 5 bucks. So you can actually get in and get exposure to these markets, particularly if you're a newer trader. You can do it in a limited risk environment. And as a person who used to be a former broker and has made a ton of margin calls, it's not a fun place to be. There's no margin calls with Nadex. Whatever you put up for the trade, there's an exchange fee of 90 cents per lot in and out, and an expiration fee of 90 cents per lot on profitable trades. All of the fees are capped though at $9 per order. So if I'm trading, let's just say I'm trading 10 contracts, I've got $9 in, $9 out if I close it. If it if I place 50 contracts or 100 contracts, though, it's still $9. And so all the fees are capped at $9. Let's see, Mark, the 2-hour spreads seem to be a fool's game. It depends. We actually have quite a few people using them. To me, they're kind of short term, but you can also oftentimes get in very low risk. And for the shorter term trader, where I see a lot of them are around the fundamental news announcements, getting in about a half an hour before something that would rip your face off in the underlying market. You can do it limited risk on a very short 2-hour contract. And then what a lot of people do is they basically get in on the 2-hour. Whatever happens in the next 15 minutes after the basically the next 15 minutes after the news announcement, then they go into the underlying market, and if they're already in a type of profitable position. Let's see. Yeah, I think Sharon was just saying the same thing. Yeah, if you're trading at the right time, the 2 hours are. If Nadex has problem like a few currency companies like PFG, MF, what would happen with our money on deposit? Well, let's talk real quick about that, because that's the topic on everybody's minds. PFG obviously went under. That was fraud. Well, I guess it still has to really go to the courts, but I consider it fraud. One thing with PFG, there was one person that was allowed to control everything basically in that company. I have about roughly 150 friends that worked at PFG, and they, a lot of great people over there, but one person was allowed to trade those funds. Nadex as an exchange, there's a couple of big differences, and I'm also going to talk about the MF Global collapse as well on the sovereign debt. If you look at how funds are held, what the NFA/CFTC, how they allow funds to be held, it's about 25 pages long. At least it used to be. That's being restricted quite a bit. With Nadex, we hold your funds in cash, in a segregated account. Segregated accounts used to mean a lot more prior to the whole collapses. We don't put them in overnight in anything. No other securities, not even U.S. debt. The reason being, all of ours are fully collateralized trades. It has to be liquid. If you have $100 in your account, we can't put that in another instrument because you have to have that to trade. Another part, as an exchange, we have board supervision. So one person can't control anything. So for example, whereas you might have in a private company, you have one CEO that is autocratic and can do whatever they want with the funds and says, hey, send this here, send that there. We have a board of 5 people. 2 of them, by regulation, have to be independent of Nadex, meaning they can't work for Nadex. So everything is supervised, both not just internally, but externally, and that board reports to the regulators. Another thing, I don't know if everybody realizes this, but when you have money at an FCM, you have what we'll call large trader risk. So let's say everybody on this call, wow, there's 417 people. Wow, that's awesome. Let's say all 417 of us had $10,000 total at an FCM, and one other institution had $10,000. So all 417 of us have 10,000. The other institution has 10,000. Let's say that institution, we saw what happened tonight a while back, 420 million in about 40 minutes. Let's say that somebody's running algos and it goes against them, and that 10,000 that institution lost all of a sudden is 15,000 that they lost. All 417 of us, that extra 5,000 can come out of our funds. It's in every agreement that you have with every FCM. That can't happen at Nadex because of the nature of the fully collateralized trades. Also, as an exchange, we can't take positions, meaning we can't trade the market. I can't say every FCM, almost every FCM, has a house account basically, meaning they're taking positions. Virtually all of them, any of the sizable ones anyway. The same thing applies. If they lose that money, what happens? Nadex, we can't take a position. We're an unbiased exchange. If we were taking positions on oil or equity indexes or currencies, we'd no longer be unbiased, right? We'd have a vested interest in the outcome of a contract. And so we're not allowed by regulation to do that. We can't take that position, so there's not that risk. Let's see. Can't speak for Nadex. No, there are never any margin calls on Nadex. So no, credit history is not an issue because they are all limited risk. And that's one of the things. Anytime you put money in though, make sure it's speculative money. It's risk capital, nothing else. The only way to trade is is with risk capital. It doesn't matter what you're in. The surest way to lose a lot is use grocery money. And unfortunately, I've talked to quite a few people in the past years, particularly when Forex was really starting up big in 2003, 2004. Uh, so a lot of people coming in thinking, hey, I can make $1 million. I love the contracts that Nadex offers. Obviously, I'm biased because I'm with Nadex, but even before I was with Nadex and I was trading these actively, the contract itself, because there is no margin call, there's no slippage. I can't lose more money than I have in my account. It's massive because I've seen a lot of people, particularly newer traders, that get in and do everything right. They put a stop on where they're supposed to, and they do really well for 6 months. And then what we used to call black swan events, which are hardly black swans anymore because they're quite common. All of a sudden, that 6 months went away, and the $2,000 they had in their account is all of a sudden negative 1,000. Particularly when we were looking at 400 to 1 or 200 to 1 in the currency markets. Wasn't that uncommon? With Nadex, that can never happen. And with that, I think I'm running a little bit ahead of time. I'll take a few more questions and then I'll turn it over. I think Daryl's up next, and he'll actually I saw a couple comments. He'll actually simplify what I just talked about. Um, and I think so with that, I'll take a couple more questions and then I'll turn it back over to Morgan or Daryl. William, yeah, actually, that's one of the things. We call these bull spreads, but think of them as a box spread, and Daryl will go more into that, I'm sure. Um, you can be long or short, so don't let the name fool you. You can be long or short a bull spread contract. One of the reasons why I hate the name is because bull to me implies the market moving up. Um, let's see, is gold, silver available to trade for U.S. residents with leverage? Well, actually, by their very nature, um, the Nadex contracts have extremely high leverage in most cases. But what they don't have is the downside of leverage, where leverage is great if it goes in your favor, but traditional leverage, if it goes against you, crushes people. It just does. That's the nature of it. With Nadex, for instance, we took a look at that oil example. Where what would it cost us basically $6,800 in margin to get into a $100,000 oil trade. We could do essentially something equivalent, meaning $1,000 per full point. We could do the equivalent in that scenario for $250. That, by its very nature, on a point-by-point basis, is extremely high leverage. However, the contracts themselves technically are very low leverage because it might be a $500 contract. Let's see, Frank, how much percentage gains have you made in the last 1 year? Well, I'm with Nadex, so I'm not allowed to trade these anymore. I was trading them prior to becoming Nadex, which is one of the reasons why I came over, and actually I helped them design this contract before I was ever part of Nadex. Same thing holds for all of the employees. We're not allowed to trade the underlying markets that we represent because we were prior to Nadex. It actually varied. I got my kind of my butt handed to me in 2009. I think I was down about 12% that year. I kept thinking that this whole quantitative easing was going to go back, but 2010 was much better. I usually historically when I look from 1998 when I first got into equities, um, from there on I typically am right around the 8 or 9%. But what I do is totally different from anybody else. You know, somebody else doing exactly what I do could lose 8 or 9% a year. Some people could gain 60%. Um, let's see. Yep. No other sides of yeah, yeah. We're not a broker. You know what? There's a lot of benefits to health insurance and to not doing the daily grind. I still trade equities, Frank, and that's one thing I still trade. So you know, working for Nadex, they actually treat me pretty well, and actually I'm pretty passionate about the exchanges itself. There's few opportunities in life where we can actually look at something, particularly in the trading realm, and say this is really good for the trading environment. We look at what's happening on other exchanges with high frequency trading, with a lot of other things, and it's just the case. I look at this as something really good for traders. The limited risk aspect. I've spent enough hours talking to people that I had to explain why they had 2,000 in the morning and then they owed the brokerage 2,000 in the afternoon because the Fed made some decision. I'm pretty passionate about Nadex and really love what I do. Yes, currently you have to be a resident of the U.S. To trade with Nadex. Um, with liquidity, it does depend on the contract. It is an exchange. Sounds like Don's done pretty well with Nadex. Nice job, Don. We don't have managed accounts. Yeah, you could use it purely as a speculative contract, or you can use it as a hedge with futures. Um, well, Frank, you can have your opinion, and I'm not sure what you mean by the majority are losing. I haven't seen that stat published. Is there a written published primer on Nadex trading? Actually, Daryl will go into that and have uh, quite a few things. There's a lot of videos out on YouTube. There's also some trading videos on our website that kind of go over the basics of the contract. And again, I opened up I opened up the YouTube channel, the thing. Open up a demo account as well. And yeah, Nathan, there is a demo account. And I'll tell you what, for everybody on this call, typically the demo account lasts 2 weeks. I'm working very diligently inside to try to get that when you have a live account to get that extended permanently. In the meantime, if you do open up a demo, if you open up a live account and fund it, shoot me an email. I'll type in my email right now. Just shoot me an email. Use the links that Morgan provided to open up your live account. Shoot me an email, and I'll extend it out for a year. I'm actually working with a few other FCMs right now. I'm hoping, and I'm keeping my fingers crossed here, that over the next 4 or 5 months, when it will be available, basically globally, because there is just a ton of people out there that I've heard from personally outside the U.S. that want to trade these contracts, and the reason being they are exchange traded. They're not over-the-counter type contracts. There's not a broker bias involved. It's a transparent exchange environment. So I'll be keeping everybody updated on when that becomes a reality. Um, Actually, I believe Patch. I believe, is that Michael? We've looked at 2-week spreads, and to be quite honest, they suck. The reason being there gets too much optionality involved. What I would look at, I actually ran a year ago. I looked at monthly, 2-week, and even 1-week spreads, and it gets really difficult to get those situated where they'd be actually tradable. It almost makes the underlying would be a bit better alternative. What I would look at is using the short term, the daily. We have looked at even doing like a 2-day or even 3-day. That might be a possibility. In this case, though, I would look, because if I'm in a trade, I want it to be able to run forever in my favor. So rather than doing like a 2-week bull spread, I would rather get in on my short-term bull spread from a trading principle. Get in with the limited risk aspect. If it runs in my favor, let's say it's oil. Using the example before, we get into the bull spread at 75.25. It goes to 77. I close that out. Close out the spread, buy the underlying, but now instead of getting in at 75 in the underlying with a stop at 74 and taking that risk of getting stopped out, now I'm getting in at 77 in the underlying, and maybe my stop is at 70.
All right, great. Thank you, Dan, and excellent job. We've got a great crowd here today, about 425 people, so we appreciate that. And a couple things just to recap. We've got a link on the screen if you want to open a live account. What we're going to do, and I talked to Daryl about this, is on Monday from about 8:30 to 10:30, we're going to do a live trading session with Nadex. And so basically, if you open a live account or demo account, send an email to support@tradingpub.com, and I'll be sure to get you an invitation to that live trading session. So again, if you open an account, you can open either a live or a demo account, but send an email to support@tradingpub.com. We're going to have a live trading session. Yeah, we'll record that as well. But that way you can see this. This will be Monday, so this Monday from 8:30 to 10:30 Central Time. And but that way you get to see some of this in a live market, and we'll go through several different things and strategies and show you how we use it in a live market. But get a demo or a live account open. It takes about 3 minutes to do so on the live account. And yeah, talk to Daryl. He was nice enough. He said he'll hop on there on Monday and show us some of the things. He's got some really, really cool software that he uses. So yeah, on Monday. So there won't be much live trading tomorrow, Daryl. But all right, well, sounds good. Dan, thanks again for being here, and hopefully that kind of gives you an overview of Nadex and the products. And I